Good afternoon, and I'm here with my colleagues, Wendy Diacono and EJ Purdy. We are wealth advisors employed by Community Choice Credit Union, offering financial life planning and investment services through LPL Financial, our trusted partner. Now, today we're pleased to have Scott Brown, a senior analyst of LPL Research, share timely information on what's been happening in the economy and financial markets. Really, the goal here is just to provide a helpful, informed perspective to assist us in making prudent long-term decisions. Now, before we begin, I recommend for your viewing pleasure, if you look in the upper right corner of the screen, there's a view button or link. And if you click on that and select side by side, that will be a better view for you. Additionally, due to compliance and other required factors, we are not going to have a chat. We're not going to use chat today. However, you will receive surveys where you can respond and request or to be called and contacted. So please take down notes, questions that you have so that we can reach out to you later. And Scott, the floor is yours.
Thank you so much, Shane. Thanks for giving me this opportunity, and good afternoon, everybody. I'm excited to present a little bit about how LPL Research is seeing the market over the next 6 to 12 months. We've had an incredibly strong year. We're, of course, going to kind of talk about how we got here, but we're more going to focus on how we think the end of the year is going to finish out and what we're kind of seeing as we turn the corner into 2022. But first, I do want to give a little bit, just kind of an introduction to everybody about, what is LPL Research? Obviously, you all have great advisors that do so many things for you, but LPL Research, we just want to highlight, is there really to support advisors through the investment process. And we do this through 4 main ways. We keep advisors and clients informed with relevant and timely market and economic insights. We provide manager due diligence, separately managed and mutual fund account managers out there scouring the universe to find the very best managers poised to outperform. We provide strategic and tactical asset allocation guidance, and we also manage money directly. Some of you might utilize some of the centrally managed LPL Research models, but LPL Research as a whole is managing north of $60 billion, primarily in mutual fund and ETF models, all informed by the same team that's writing those economic insights and providing asset allocation advice to advisors that choose to do it themselves. All of this is, kind of grounded in a strength and independence. LPL Research has no proprietary products to sell. We are completely compensated on how our models perform for you, the end client. And so we really try and support all of the LPL advisors as best we can. But hopefully this gives you a little bit of insight into exactly how we're seeing the markets right now and how we're positioning all of those portfolios. A little bit about myself first. So I'm a senior analyst and technical strategist for our team. I joined LPL back in January 2016. So coming up on my 6th year of service with a firm. Really enjoy what I do. I help manage some of those models, inform our overall asset allocation views, and then, as mentioned, also do technical strategy. And I always feel the need to kind of explain to people, because that's kind of, I think people are used to economists. Everybody knows what an economist does, and we're going to focus a lot on fundamentals in the economy. But sometimes people hear technical strategy and they either don't know what that necessarily is, or they have maybe some misperceptions about what it is. So maybe let's first just talk about what technical analysis is not. This is not what we do here at LPL Research. We don't just put a bunch of lines and we don't just follow random, made up price patterns and say, hey, look, we're buying this because this happened. We're not doing what all the Bitcoin traders or anything like that does. What we really try and do, though, is focus on price, market trends, and what the market is telling us, because that's the only thing that shows up on your statement at the end of the day. Apple's earnings, they never hit your statement. The only thing that really matters is what did you buy and how much did it go up and how much did your account go up. So price is very, very important. It doesn't matter how great your thesis is. If the market doesn't ever agree with you, you are wrong. And so we're going to take the first kind of example of this and dive into what's probably the number one question on everybody's mind: inflation. Everybody has been talking about inflation. I know, because my parents are now asking me about inflation and is it going to continue? And that's how you know it's really, really gone mainstream. And so we hear a lot of talk about inflation. We read about it on the news. We see people on CNBC talking about it. But what does the market actually think about inflation? Is the market pricing runaway inflation? Well, we look at a thing called break-evens, and this is a little bit wonky, but this is basically just a way to tell what the bond market thinks inflation is going to be over the next 10 years. And you can see it every single day based on the differential between different types of bonds that people want to pay for, including regular bonds and bonds that are protected from inflation. And that difference will tell you how much inflation the market is expecting. And we look at the market right here, and there's two things that really stand out. One is that inflation expectations for the market basically topped out in May. They've risen a little bit here in the past 6 weeks or so, but all in all, they're about flat over the past 6 months, even though it seems like every single day there's another inflation reading. We just got the highest CPI print in 30 years. So we know we've had some inflation, but for it to really be inflation, it's got to be a phenomenon that continues on and on. So does the market think there's going to be a lot more inflation? Well, it doesn't really think that there's going to be much more inflation than it thought there was going to be in May. That's one key point. And then there's just a hard number. How much inflation is the market pricing in? What's that number over there on the top right of the screen? It's 2.7%. The Fed, for the longest time, ever since the financial crisis, has been trying to get inflation to 2%. It struggled to do that. We've obviously gotten some short-term readings that are well above that, but does the market think that's going to continue? It really doesn't, and we think that's an important thing for people to recognize. Is the smartest minds in the world, the bond traders that are putting their money on the line, they think a little bit more inflation than we've had, but not really anything that could be considered runaway, and certainly a far cry from the 1970s double-digit inflation. But again, this is very much in the news. You know, a couple of years ago, we had the far right cover from Bloomberg Business Week, "Is inflation dead?" Well, sure enough, then we've got inflation that has kind of pretty steadily risen following the pandemic. And then this cover, and this kind of shows you that tends to be that the reporters are a little bit late to the party. This came out in early May. Just real quick, what happened in early May? Oh yeah, this is where inflation expectations actually started declining. So by the time it really goes mainstream, usually the market has kind of moved on. We've got Barron saying the I word. There's a lot of concern. We've got Jack Dorsey, the CEO of Twitter. He says hyperinflation is coming, not just 5-6%. He says hyperinflation. So in general, let's not take financial advice from people that look like this, but let's also do the work and let's see what actually is kind of happening under the surface. First and foremost, we're not making the case that inflation hasn't happened. And we actually think that we'll probably continue to see elevated CPI reports, those monthly inflation reports, probably come in well above 2% for the next 6 months or so. But we think that it's going to start to come down because the primary driver of these higher inflation readings is supply chain issues. What's the number one example that most people have kind of run into over the past couple of years? Well, used car prices. I mean, used car prices are a tiny part of the inflation calculation, but they've been so astronomical. They've accounted for a huge portion of the gains. The June CPI report, used car prices jumped 10% in just 1 month, accounting for 1/3 of the increase. You know what used car prices have done since June? They're basically completely flat and unchanged. That semiconductor problem holding up new cars, it feeds into used cars, but it's slowly working its way out, and we're starting to hear evidence. The CEO of Toyota out with news that we think we've seen the worst of the semiconductor shortage from their supply chains. Some other companies are still working through it, but all in all, we think that that is a huge reason for a lot of these elevated inflation readings. We also just have the basic disconnect. Traditionally, in a recession, supply and demand go down together. And so everything is really bad, but there's a balance. And so prices generally pretty stable because sure, supply is down, but demand is down. Well, what happened this cycle? Okay, we had supply shut down, we had supply chain shut down, people go home, restaurants were closed, but demand stayed pretty steady. We couldn't go to the restaurants, but people were spending money like crazy. Why? Because one, people were able to work from home, and two, fiscal stimulus. The government put money in people's pockets that kind of kept demand elevated, arguably maybe even higher than it would have been. And so you get this disconnect that prices kind of have to account for. However, without that factor, without more fiscal stimulus going forward, we don't necessarily see the case that inflation is going to keep running and running in the future. Now, if there's a risk to that call, one thing that we want to keep an eye on is wages. The second thing we want to keep on is rising rent prices. This chart is a little bit kind of in the weeds, but it does show you that the sticky inflation, rent inflation, home prices have gone through the roof. Well, if rent prices tend to follow, they're a big chunk of the CPI calculation. So if they start to trend a little bit higher, maybe we do have above average inflation. We still don't think it's hyperinflation, but it's definitely something that everybody will be closely monitoring, us included, in 2022. And because that's sticky inflation and these inflation reports have been elevated, the number one thing that we're all going to have to keep hearing about, and just get ready to hear a lot of it in the next year, is the Federal Reserve. Get ready to hear a whole lot about the Federal Reserve. And there's kind of two things you're going to hear about. One, maybe a little bit more in the near term. First, over on the left-hand side, that's the current Fed chair, Jerome Powell. He's pretty widely been expected to keep his post at the Fed. It's appointed by the president, but he can be renominated by Joe Biden. He's been pretty widely expected to keep his job. People feel like he's done a generally good job. He obviously navigated through the pandemic, and the markets don't like change. But here in the past couple of weeks, there's a little bit of rumors that maybe his job is in jeopardy and we could get a new Fed chair. Could that introduce a little bit of short-term market volatility? Maybe the most likely candidate, the name would be Lael Brainerd. They lean a little bit more dovish. That's just the way it is. But overall, that would probably be a market positive, but you also want to be aware that market change can create short-term volatility. But regardless of whoever's in the chairmanship, when is the Fed going to hike rates is going to be one of the most important things that both equity and fixed income investors are watching next year. And so right now, the Fed funds rate, what the main rate that the Federal Reserve controls, that thing that's tied to your savings rate that you get in savings accounts, and so much of the bond market is tied to the federal funds rate, it's zero. We cut rates to zero to make money easier to access in the pandemic. That's been pretty typical over the past 20 years. That's kind of the new strategy. But we also, don't feel that zero is exactly normal. And so the Federal Reserve for the past 6 months has been pretty adamant that we're going to keep rates at zero for a long, long time, well into 2023, well into 2024. But now we've had these higher inflation readings. And how do you combat inflation? Well, you raise interest rates. And so now the market is pricing in that, hey, the Fed's not going to be able to wait to 2023. The Fed's not only going to have to potentially hike in 2022 at some point, they might hike as early as June. And that's what you see in this graph is this blue line here. The odds of being at zero in June, just in the past 6 weeks, have basically fallen from 90% to about 40%. And so the market's kind of saying, hey, the Fed might have to hike rates to combat inflation. Exactly when that's going to happen is going to be a huge topic for the market. We don't think it's actually going to happen in June. We think there's a good chance you might see it towards the end of the year, the back half of the year, but we don't think it's going to happen quite that quickly. We overall expect inflation readings to moderate enough for the Federal Reserve to realize that it's mostly about supply chain issues, but it's something we want to monitor because if the Federal Reserve is hiking aggressively and there's not that much of an inflation threat, that's when equity markets tend to get a little bit worried. So something to keep an eye on. Unfortunately, we'll all have to just keep hearing about what is the Federal Reserve going to do, though. Let's talk about the economy. What's actually happening in the economy? Because overall, our view is that the economy is very, very healthy. We're not fully back. We're not out of the pandemic. That's absolutely for sure. But GDP is expected to grow 4% next year. It's going to grow about 6% this year. And 4% might not sound like a ton, But for the past decade, we've averaged 2%, and we've struggled to get anything above 2.5%. So doing 4% next year with no fiscal stimulus, we think is really, really positive, sets up an overall favorable environment for stocks, the economy, and we're going to talk about how we're positioning portfolios. But more cyclical risk-on sectors should benefit from GDP growing about 4% next year. And we also have had an economic reset. We had one of the longest expansions on record beginning at the end of the great financial crisis. And then, basically it stopped. It technically stopped with a recession in March of last year. But now we've gotten a reset. And the average economic expansion going back to the 40s is 5 years. We're 18 months into it. So there should be plenty of time for the economic expansion to continue. What do stocks most care about, though, is earnings. The stock market and the economy are kind of loosely tied together. The stock market is always going to be moving quicker. That's why the stock market completely melted down basically before COVID really hit. Before there was any real acceleration, the stock market completely melted down. And then it was basically rallying throughout all of last year, the worst of COVID. We know how bad this time last year was. And the stock market just never looked back. And it's because the market is very forward looking, but the market is also always worried about future earnings. It's not so much about what the economy is doing today. It's about what future earnings for stocks look like. And the good news is that earnings have been nothing short of incredible this year. So you look at the far right, those 4 bars over there, earnings growth this year is something that we'll probably never see again in our lifetimes. Now, we expected Q2 earnings to be very, very strong because they're compared to the second quarter of last year, the height of the pandemic, the very beginning of it. Earnings were terrible. So it was kind of it was a layup. It was very easy to have explosive earnings growth. But Q3 and Q4 of this year, by Q3 and Q4 of last year, we started to see earnings normalize. Earnings actually grew in Q4 of last year. And despite that, we're still going to see about 40% or maybe close to 40% earnings growth in Q3 of this year and more than 20% in Q4. And so that's really, really incredible. One of the most amazing things about this market is even though the S&P 500 is up well over 20% so far this year, on a price to earnings basis, stocks are actually cheaper than when we began the year because earnings have grown even more than stocks. And we see that continuing to drive earnings into next year. You look at the 2022 number, that's the difference between how much expectations were at the beginning of the year, and then we've climbed that even more. That's as of late June, so kind of the end of the second quarter, and earnings are expected to grow even more into 2022. And so if earnings are growing next year relative to this year's earnings, it's really hard to not expect more stock market gains for 2022. And we just took off one of the biggest potential risks to earnings and maybe the market the investors were looking for. I've been sharing this slide for 6 months. We don't need it anymore. It's the S&P 500 index performance after we've had an increase in the corporate tax rate. And this is not political. This is what there's a famous investor, his name is Jeff Gundlach, calls the bloodless verdict of the market. There's not a lot outside of fear and greed in the short term that the stock market cares about, except for earnings. And so what you see here, and I know it's a little bit covered up, but over the next 12 months, whenever there's been a corporate tax increase, if stocks are the discounted future cash flow of earnings, if you have a corporate tax increase, the companies have less earnings. And so stocks are a little bit less valuable. If you have a tax cut, they have more earnings. Stocks are going to be a little bit more valuable. And what you see is over the next 12 months, stocks were not down on average, but this 4.2% return and only higher about 62% of the time is about as bad as it gets in most market back tests that we do. You really don't find a lot of times that something happens and you test it out like this and the stock market is just down 100% of the time. But when you're only up 62% of the time and you're getting half of the average next year's return, that's kind of bearish. Luckily, we don't have to worry about that because now it looks like there's going to be, we just passed the infrastructure bill, Build Back Better, and all those things. And we did it without getting a higher corporate tax rate. And that's important because that was actually a very rare market surprise. This is something that we look at for policy decisions just to kind of gauge where the consensus is. This is what the market odds were. It's kind of a fun site. If you're really into politics, you can check it out. It's called predicted.org. But this is what the market odds were, that the tax rate, the corporate tax rate was going to be 21%, which it was and is right now. This is what it was going to be next year. The odds that it was going to stay the same were about 20%. Everyone thought there would be some version of a tax increase. Well, all of a sudden, that skyrockets, and that's a market surprise. And so it's like the market is expecting to have less earnings next year. And then all of a sudden it's like, nope, no corporate tax increase. Companies get to keep more of their earnings. What happened exactly around the time that started skyrocketing? Oh yeah, we got this most recent rally in the S&P 500. So this is just a chart of the S&P 500, but we had a little bit of a pullback. It was actually the first time that we had a 5% pullback this entire year. I mean, this has been a remarkable straight up year with almost no volatility. Nice contrast to last year. But as soon as it kind of became clear to the market that we weren't getting corporate tax increases, you got this most recent rally, and here we are just sitting 1 or 2% off all-time highs. And all-time highs are about to be something we talk a lot about because we think it's really, really important that end investors know all-time highs are a great thing. All-time highs are a sign of a bull market. All-time highs are not something that we want to be selling into, and that normally new highs are followed by more new highs. The market goes up over time. It's got to consistently be pushing up to new highs. So we're going to make that case, but we also want to point out this is not a market being led by just a few stocks. This is another one of those things that we consider technical strategy, but we know that the market is at all-time highs. But how are individual equities doing? Well, they're doing a lot better. Actually, there are a lot of stocks that had a correction over the course of the summer, and there was a little bit of a time where some of the top stocks were doing most of the heavy lifting. That's not the case anymore. We saw a big boost in participation, and now we have the highest percent of stocks in short-term uptrends. That's what we're seeing right here. Short-term uptrends, most stocks since about May. This is good news. And it's also good news this time of the year. It's not just the holiday season. It's the most wonderful time of the year for the stock market. If anybody's ever heard the old expression, sell in May and go away, you can kind of see it here in this chart. Returns in the middle of the year tend to be pretty choppy, but at the beginning of years and at the end of the year, starting in about the middle of October, here's where we are right today, markets tend to rally. And we look at kind of a same data, different chart. The fourth quarter is by far the best. How much higher, or how often is the fourth quarter higher? Almost 80% of the time, and almost half of your average year's return just come in the fourth quarter. So the Santa Claus rally, whatever you want to call it, it very much is something that's backed up by real economic data. But I want to go back to that point about big gains. They aren't bearish. They aren't a reason to be concerned. You shouldn't be selling because you've got a fantastic statement at the end of this year. Big gains usually lead to big more gains. So just want to kind of show this. And this was what happens when the S&P 500 is up more than 20% at the end of October. 20%, I mean, the average year does 9%. I probably should get out, right? That's what logic says. Markets go up, markets go down. We've been up a lot, probably time to go down a lot. Look at the statistics for this. The final 2 months of the year and November, which we're obviously on track for a gain here in November, have never been negative when you've had a 20% gain through October. And that kind of goes back to technical strategy and following trends. Strong markets tend to stay as strong markets. So never been positive, really, really positive return or positive sign for returns through the end of the year. But what about a little bit longer? Well, back in September, we had that 5% correction, and we actually broke a winning streak. We've been higher 7 months in a row. October broke it, so we didn't get to 8, but 7-month winning streak. What happens now? Look at 6 months later, after a 7-month win streak for the S&P 500, higher 7.9% of the time, on average 93% higher. The worst you've ever done is -3%. 12 months later, it kind of falls back to average, but this 3 to 6 months after September, you've never done worse than -4%. So strength tends to lead to more strength. And the very last thing that we want to show, kind of on this same theme, is new highs tend to come in bunches. This is a big thing for us at LPL Research. We think that we are in a secular bull market. You really go look back at market history and you see these times, kind of the late 50s and the 60s, where you get a lot of new highs. And then the 70s were a really bad time for investing. We had that higher inflation and things like that, but almost no new highs for the market. Not a lot of stock market making new highs. Then we had the mid 90s. Everybody focuses on the 2000s and how that ended, but nobody forgets that that basically started in the early 90s. You had 10 years of just stock market gains and more gains. And what's happened here in 2013, we finally broke out above the great financial crisis highs, started making new highs. And we're on track for the second most new highs in 1 year ever. What's the number one leader? What's got the record? It's 1995, right in the middle of the 1990s bull market. Just notice that it wasn't 1999 or 2000 that saw the most record highs. You actually tend to not see these blow off market tops. That makes for a great story. But under the surface, there were a lot of signs of weakness in 2000, and the same thing in 2008, where we just kind of slowly rolled over. And after months and months of stock market weakness, then you got the worst of the selling. Right now, we're just seeing tons and tons of strength. And so we want to make another point, is that even though the S&P 500 has just been going straight up, most of the market is not. We showed that little graph with short-term stock or short-term uptrends for stocks. Here's the Russell 2000. This is small cap stocks, really maybe a better reflection of not just a bunch of large technology companies, but like companies that you might be more likely to interact with. Sure, we all interact with Apple and Microsoft, but the day-to-day economy, a little bit more tied to small caps. The Russell 2000 went absolutely nowhere from February through about the end of October of this year. Just 7, 8, 9 months of no gains for the Russell 2000, following one of the best fourth quarters for stocks ever. And so just consolidating those gains, and we just broke out, and 30% of the Russell 2000 broke out with it. So this is a really strong surge of individual companies doing well after not doing that great for so long. We think this is a positive sign. We actually really like small caps here. They've been one of our favorite areas, and we see some signs for continued strength. We'll talk about some other sectors that we like in a minute. Now, we've been pretty bullish. We definitely feel like we're making the case because clients have a lot of worries. The news is always happy to feed you the fear, feed you the headlines about what you should be concerned about. And so we do think it's important to kind of show, here's what the data says, but we also don't want to be dismissive of the risks. What about Delta? There's the Delta variant, and there's it's going for your fall plans. And I know we're almost through fall, but I like that slide, and I'm going to keep using it right up until December 21st, when it's just no longer relevant. But we don't want to be dismissive of this because it's absolutely affected the economy. It definitely caused a little bit of a slowdown in the fourth quarter. And even though we think we've seen a clear peak, we are starting to see case counts rise in some areas of the market. This is actually similar to a pattern that played out in the UK and is kind of playing out in Europe, where you had a pretty big peak, you declined a lot, and then you kind of saw a spike up. We don't think we're going to go back above that September peak from the Delta wave, but we need to be aware that this is something that, maybe people hoped would be in the rearview mirror by this point, and it just isn't. It's kind of something that we've got to live with. I got the virtual background now, but I'm sitting here at my home doing this. I don't think anybody expected that we would kind of still be home or still in this hybrid work situation 18 months after COVID, but that is the reality. The good news is the consumer remains really strong, and we managed to get through this latest. And I know this is, it might be a little bit different in different parts of the country, and different municipalities take different, approaches to handling it. But overall, we got through the latest Delta wave with above average economic growth, with a strong consumer, without additional fiscal stimulus, and without lockdowns. We've got to do some things to mitigate the virus, But from an economic standpoint, from an S&P 500 earnings standpoint, which is, again, for better or worse, almost all the stock market cares about, we got through it without any real impact. Again, going to see almost 40% earnings growth in Q3, and that's how much delta we had. Think about if COVID cases actually go down. So we think that that's overall good news. We think it's good for the economic environment that we've seen this peak. We think that that's one reason that interest rates have actually pulled back since March, and it's now started to rise. The yield on the 10-year Treasury got up to about 1.77% at the end of the first quarter, and then fell all the way back to 1.1% just a couple of months ago. And now we're back up hanging around 1.65%. We think that we've kind of seen the bottom in longer term Treasury yields, that they're going to continue to rise, and that overall rising rates within equities, that's good for those small caps that we talked about. This chart here shows that 10-year Treasury yield. It's the 10-year Treasury yield in orange. You can see the pullback that we talked about all the way to 1.1%, and then it's moved back higher here recently. And this is the small cap to large cap ratio. So this blue line looks just like the orange line, because when interest rates are rising, small caps tend to outperform large caps. And that's what that shows, that the blue line moves up when the Russell 2000 does better than the S&P 500. So there's a lot of correlation there. So we think rising rates, good for cyclicals and small caps. You can see some of our favorite sectors over there on the right-hand side: materials, industrials. Those two sectors just broke out after a pause similar to Russell 2000. Financials have actually remained incredibly resilient over the past 6 months. Even though the yield curve is flat, and even though interest rates have pulled back, financials still look very, very strong to us. We like technology. We like the growth areas of the market. We're just kind of more neutral. We're favoring the cyclical values for alpha. We don't, again, but we aren't negative on them. We just think they're going to kind of more market perform right now, which is really what they've done over the past year. And then the only thing that we're outright negative on is just defensive assets. We talked about we're still early in the economic expansion. Early in economic expansions, you really don't want to have big positions in utilities and consumer staples. Why? Because those are safe areas of the market. Those are things you want to own late cycle. You want to have a lot of consumer staples and companies that are rock solid, and they're, the demand for their products isn't going anywhere in recessions. But we're pretty bullish, and so we just don't think that having overweights to those areas makes a lot of sense right now. Lastly, real estate is kind of the outlier. It can be a little bit defensive, but it can also be pretty cyclical. Certainly some companies more exposed to economic weakness than others. We've seen a lot of strength from the reopening names, things like malls in the real estate sector, and so that's why we remain positive there. Now, rising rates isn't a good thing for everybody's portfolio, though. There's certainly ways to profit from it, but rising rates, unfortunately, pressures fixed income returns. Price and yield are inversely correlated. When interest rates rise, that means the price of the bonds that you might currently hold become a little bit less valuable to account for the higher interest rates that can now be had out in the marketplace. So we aren't super positive on the fixed income market over the next 6 to 12 months, but that doesn't mean that we're recommending sell all of your fixed income. Just recognize there are ways to profit on the equity side. And our message to investors is let your bonds be bonds. The quote there at the top is diversification means always having to say you're sorry. We think diversification is very important. If everything in your portfolio is going up at the same time, guess what? You're not diversified. So we just kind of want to lower expectations for fixed income returns. But the best thing that can happen to bond investors is rising interest rates, because that means in the future, your returns will be higher. Your returns are basically the coupons that you're getting. So we got to have interest rates move higher to ever get higher fixed income returns. For now, just accept that your bonds are there for diversification. And that's what this chart here shows. Months when the S&P 500 is down at least 3%, what do treasuries, high quality bonds do? They go up. Almost every single time that those dark blue lines are negative, treasury bonds are higher. You want to have that to be able to rebalance into. So again, fixed income returns, not incredibly positive, but there's still plenty of good news for the equity markets. And just to kind of wrap it up so we don't have to end on a poor note with your sour fixed income outlook, just remember that there is a lot to be thankful for. We're actually doing our weekly market commentary this coming Monday. Just wrapped it up. There's a lot to be thankful for this year. Obviously, we have not completely gotten past COVID, but I think hopefully we can all agree we're in a lot better situation than we were this time last year. You know, vaccines are very much there. People are getting out, people are spending money. Again, we've still got to do things, but overall, the US consumer remains strong. Stock market strength is signaling more stock market strength into next year. We believe we're early in an economic cycle. So hopefully we're a whole lot more towards kind of a normalized view of the world, kind of getting back to investing, being a little bit more fun, not so much portfolio watching, but always remember that we are here to do that. Your advisors are here to do that for you. You get out and do what you do and what you enjoy, because we do think that we have a lot to be thankful for. There's really just open roads ahead. This has been our big theme for our mid-year outlook, is kind of a restarting the engine on the economy. It seems like we're up and going. The engines are kind of running at full throttle. So hopefully open roads ahead is kind of how we're seeing it. We will be excited to kind of bring you, stay on the outlook, or be on the lookout for our new outlook, which will be for 2022, coming out in just a couple of weeks, the first week of December. So you can kind of lay out all the things that we've talked about here today, but with kind of a different presentation and a different theme. So we're really excited for that. So with that, I'll throw these disclosures up here. Thank you all for giving me the time to present. Thanks for listening. If you have any questions, please reach out to your advisors. They can answer your questions, or they can reach out to me, and we'll absolutely get those questions answered for you. But again, thank you for taking the time out of your busy schedules and allowing me to present, and I'll toss it back over to Wendy.
Thank you so much, Scott. That was wonderful information, very timely, very informative. I want to thank all of the attendees for attending today. Please feel free and reach out to our assistant, Beverly Humphrey, as she can connect you with one of the wealth advisors. I'm Wendy Diacano. I'm one of the wealth advisors, along with Shane Robinson and EJ Purdy. But Bev can be reached at 877-243-2528, extension 1330. And at the end of this presentation, you are going to receive a brief survey. Please take a moment and complete it for us and let us know how we're doing. Again, thank you again for attending. Have a wonderful, safe holiday season. Thank you.